Now let's talk about the East versus the West. We know that this has been over centuries a reoccurring topic. Alexander the Great versus Darius of Persia, the Crusades, the Ottoman Empire versus the Austro-Hungarian Empire, and of course the Cold War. Now we are seeing that in geoeconomics, a showdown is approaching, a showdown between the saturated establishment and the hungry upstarts in emerging markets. If you have a look at this chart, it shows the share of global GDP in purchasing power parity. And actually in 2020, the BRICS have already taken over from G7 nations. Now with the last BRICS summit in South Africa, they decided that 6 new members will join. But Mr. Milei in Argentina, he backed down and said, well, I'm not going to join the BRICS. I will be in the dollarization camp. Pretty interesting development. But still, it is Saudi Arabia, Egypt, Ethiopia, Iran, and the United Arab Emirates joining the BRICS now, which is pretty important for the gold world. You probably saw this tweet coming out from the Russian embassy in Kenya. This brought quite a lot of excitement in the gold world, and it said the BRICS countries are planning to introduce a new trading currency which will be backed by gold. Now, I would be a little bit cautious and take every information that comes out from the Russian embassy in Kenya with a grain of salt. However, what is crystal clear is that gold plays a major role for emerging markets. Have a look at this chart. In 2022, we saw an all-time high in central bank buying activity. For 2023, we haven't seen the final numbers yet, but it will clearly be above 1,000 tons. So significant. Now, what changed actually? What's the main reason for that? What's the trigger? It was the decision by the West in February 2022 to freeze the dollar and euro reserves of the Russian central bank. Now, we have seen over history sanctions against pariah states such as Venezuela, Iran, Afghanistan, but never before have we seen sanctions against a state with veto power in the UN Security Council, a former member of the leading economic nations, a nuclear power, and one of the most important exporters of raw materials. So this decision by the West against Russia, from my point of view, was really a trigger for many emerging market countries to rethink their allocation. Because it showed that reserves can quickly transform from a highly liquid asset to useless pieces of printed paper. And from my point of view, more and more countries will reconsider the allocation of their gold reserves. And the numbers that we're talking about are enormous. At the moment, the global foreign exchange reserves of central banks amount to 12 trillion US dollars. So ladies and gentlemen, gold has re-emerged as a neutral monetary reserve asset. But it's not only central bank demand that is dominated by the East. Have a look at this chart. It shows quarterly consumer demand for gold, BRICS versus G7. China and India alone, they went from 28% of global gold consumer demand in 2000 to now 50%. India imported 17,000 tons of gold in the last 2 decades. At the moment, Indians hold 29,000 tons of gold, which is more than the combined holdings of the 27 largest central bank gold holders in the world. China has imported 18,000 tons of gold over the last 20 years. And even though the PBOC reserves are pretty small, a Chinese official recently said, when he was asked how much gold China actually has, he said, China owns gold through its people. Very important quote from my point of view. So ladies and gentlemen, if you think about gold, always think about these flows that are going from the Western world to emerging markets. So the flow of physical gold has shifted from West to East in the last couple of years. And the price of gold is increasingly being made in Dubai, in Shanghai, and in Mumbai, and less so in Zurich and London and New York. Now, are we seeing the renaissance of gold as a central bank asset? Yeah, perhaps. Central bank demand might become one of the main drivers of this next bull market. What you see here is global central bank gold holdings as a percent of foreign reserves. And you can see that in the 70s up to the 80s, central banks held 70 to 80% of their reserves in gold. Now, are we going back to those levels? Probably not, but we can easily double to 35 to 40%. And this is a heel turn, ladies and gentlemen. The bad guy becomes the good guy. We're seeing that gold is coming back into the system as a neutral monetary reserve asset.
Quick break here, guys. Today's episode is brought to you by Coppernico Metals. Now, regular viewers of my channel will be familiar with the entrepreneur behind Coppernico. His name is Ivan Bebek. Now, although a young man in this business, Ivan's already created tremendous value for his shareholders in the past, namely with Caden Resources, which he sold to Agnico Eagle, and Keegan Resources, which became a mine now owned by Galliano Gold. Now, Ivan has surrounded himself with expertise from BHP, Newmont, and Barrick on his board at Coppernico Metals. Check out coppernicometals.com. Now back to the interview.
But now let's talk about the showdown in the price of gold. First of all, look at this chart, a table showing the performance of gold in various currencies. While gold was up 13% last year in US dollar terms, gold was up 21% in Japanese yen terms. Gold was up in euro terms, 9.7%. And the compound annual growth rate since the year 2000 in dollar terms, 8.5%. 8.5% performance every year. I would say not too shabby. However, if we have a look at Western financial investors, you could see that Western financial investors couldn't care less about gold at the moment. We've seen outflows in gold ETFs last year, even though gold was making new all-time highs. Outflows, roughly 250 tons. But there we're also seeing a divergence between the East and the West. While the Western investors have sold dramatic amounts of gold, Eastern ETFs even saw inflows. And from my point of view, ladies and gentlemen, investor demand will at some point kick in and new players will enter the field. So investors' demand could be the marginal demand that we will really need to see coming in for more momentum in the price of gold.